of both equities and fixed income. It'd be nice if you could just live in that world, Kevin, but your firm won't let you. And they say you've got to manage money whichever way you can for clients, so you're stuck with equities too. But and at this point, I think you favor domestic equities.
Yes, we continue to favor domestic equities. It's been our portfolio positioning for about the last 2 years. And the reason for that is that you keep seeing earnings revisions go up. And so we think that equities have the ability here to continue to grind higher.
The latest Fed speak and what you just heard Steve talking about, I looked at your notes and what you're feeling, and I don't think that you would be surprised by what you just heard. And you're still of the opinion that you don't fight the Fed, but just know that the writing's on the wall, that at some point in the future, we're at least going to get more serious about possibly tapering.
You're correct, Joe. I think that what we're seeing right now is that Jackson Hole is going to be the 2-minute warning for the Fed. We continue to believe that September will be the announcement. The Fed has said that they want to give the markets plenty of a lead time. And we think that if it's September is the announcement of the taper, then that gives you 2 months to start tapering in November. So, Jackson Hole, as we see it, is the 2-minute warning for the beginning of tapering.
You point out that, and I don't know if was baked in, but even though earnings this last reporting season were pretty solid, you didn't maybe get the bounce you could have expected from seeing numbers that were so good. Why is that, and what could be the next catalyst if we're going to move higher?
Well, I think a large part of that is that a lot of the earnings has been brought forward. And so, market has rallied because they, saw the growth that was going to come through in second quarter earnings. The problem that we face is that going forward, what is going to be that catalyst? Now, everyone has said for about the last 16 months or so that there's no other alternative. And so equities has won out. And we think that that's going to continue to be the case because you have yields that have come back down. The bond market is telling us that they're worried about growth. And that's why we see the 10-year below 1.5%. And, when you think about in comparison to equities, the 10 years at, 126 and S&P, the dividend yield on the S&P right now is about 135. So I would continue to like equities over fixed income, largely because you have more upside potential if earnings actually come through. And like I mentioned earlier, we are seeing earnings revisions go up for 2022 for next year. We're seeing S&P operating earnings estimates now at $217. So if you put the current multiple on there, you can get somewhere close to 4,900 on the S&P.
Shepard Smith here. Thanks for watching CNBC on YouTube.